Welcome to VTS Options. So in this video, I'm going to go over one of the most basic, but also one of the most important option types there is out there for anyone trying to get into options trading, and that is the long call. It's basic because it is just a single leg option, very easy to set up, and the risk-reward profile is about as straightforward as it gets. But it's also one of the most important option types because it is one of the basic building blocks of all the more advanced option spreads that I personally like to trade. Calls, puts, or a combination of both are in everything we do within the options trading world. So in order to get to the more interesting things like Iron Condors, calendars, verticals, all that cool stuff, we do have to go over the foundation. And as always, you have an open invitation to claim your free trial on my website and join the VTS community when you're ready. But now let's get into the long call. So first we'll go over the basic risk profile of the long call, as well as touch on the effect of some of the major option Greeks. And then after that, I'll open up my trading software and show you a real example to reinforce these points. So this is what every long call looks like. We've got our standard price axis with profit and loss, and then the risk profile of the long call. Like I said, this is just a single leg option. It's set up in your trading software by simply buying to open a call option. So looking at the basic example here, we've got stock XYZ currently trading at $50, and we're going to buy a 50-strike long call option for a premium of $5. So the black line here is what the trade looks like at expiration, and that curved pink line is the daily profit curve showing where the trade is currently at. Now, of course, at the moment of opening the trade, the daily profit curve always starts at 0, and then moves around after that depending on whether the trade is up or down money on any given day. So down here, we've got the maximum loss for the trade, which in the case of long calls is capped to the premium paid. This contract cost $5 to open, so we can multiply that by the options factor of 100 and see that our maximum loss is capped at $500. This makes long calls limited loss trades. You can't lose more than the premium paid for the contract. And then up here is the potential gain. Long calls have unlimited upside, because technically the underlying stock or index being traded can rise to infinity. And lastly, the break-even point at expiration is here, which is simply the strike price plus the premium paid. XYZ is trading at $50, and we're buying the 50 strike for $5, which makes the break-even at expiration $55. For long calls, the break-even point at expiration will always be higher than the current stock price, because you're paying a premium up front to open it. This means the underlying has to move in the right direction and get to at least that point for the trade to be profitable. It's a bullish position. Long calls are bought when the trader has a very positive outlook on the underlying stock. The option Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. There's many Greeks, but actually only 3 that we focus on that cover the 3 factors most relevant to options trading: price, time, and volatility. Delta is an option sensitivity to price. Long calls are delta positive, meaning they profit from increases in the price of the underlying. Remember, it's a bullish trade, so it's delta positive. Theta is an option sensitivity to time. Long calls are theta negative, meaning they do lose value with the passage of time. So whatever move you're expecting in the underlying, it's best if it happens sooner rather than later so the negative theta doesn't eat away at too much of the position. And lastly, Vega is an option sensitivity to volatility. Long calls are Vega positive. They gain value with increases in volatility and lose value with decreases in volatility. So ideally, they are best open during periods of lower volatility. So there's a little room for volatility to go up and have the trade benefit from that positive Vega factor. So that's the general profile of the long call as well as the 3 most relevant Greeks. Now you can always come back and reference that table if you need, but now let's get into an actual trade example. Okay, so this is the Thinkorswim platform from TD Ameritrade. Now, your software may look a little different than this, but all the general points should hold true. Now, this is the S&P 500 for a 1-year chart. And just in the last few weeks, we broke out to new all-time highs, so right now the stock market is pretty high. As far as trading long calls, which are a bullish trade, it might be a little bit difficult to find things that have any potential for explosive growth here. If anything, we might be expecting more of a short-term pullback. But remember, options don't have to be traded just on stocks or indexes. We can find other asset classes as well. So I'm going to go over a trade today that I actually took inside the VTS options portfolio. And it's on an underlying that I do talk quite a bit about, and that is the VIX index. So this is a one-year chart of the VIX index, and you can see we are approaching levels that it doesn't get to very often. Right now it's trading at 1207, and in the last year this has marked the short-term bottoms in the VIX. Now, of course, it can go lower than this. In 2016, 2017, it did dip into the 9s and 10s, and basically stayed there for a year and a half, aside from some short-term pops. So I'm not saying 12 is the bottom in the VIX, but at least in the last 2 years, that's been the case. It's certainly a level that we can start eyeing some trades. So for me personally, if I'm looking for a long call and I don't really see any stocks that I think might have an explosive upside, I can always look to the VIX index because, as you can see, if we do see a little bit of trouble in the market, we can see significant upside rather quickly. So this is going to be the underline for the trade example. Now, I will say that in some trading softwares, you do just input the VIX just like any other stock. But there are some that require a special ticker, so you might have to contact your broker and just see what the symbol is to pull up the VIX. So we can go over to the Analyze tab. So these are all the choices that we have. Now, remember, I did mention for long calls, they are theta negative, which means they will bleed capital over time. Whenever I'm trading long calls, I do like to give them a little bit of time to materialize and make sure that theta isn't eating away too much of the option value, so I will go forward a few months. For this example today, this February contract with 101 days to expiration, this one will do just fine. So with the VIX trading at 1207, let's just go one strike out of the money and do the 13 call. And here's what that looks like. So it's that familiar shape, all long calls look like this. In my software, it's the turquoise line that is what the long call will look like at expiration. So this does not change. However, it is this pink line, the daily profit curve, that's the one that we're going to be looking at day to day. This will move up and down depending on how the trade is doing in the moment. You can see this little hash mark, that's the price right now, and we are basically at zero profit because we are just opening the trade now. So we did the 13 strike, and it's going to cost $5.40 to open this trade. So the important points to note here, remember long calls are limited loss. We can calculate the maximum loss for the trade very simply by taking the premium that we paid for the contract and multiply that by the number of contracts. And then remember each option contract is equivalent to 100 shares. So $5.40 times 100, you can see the maximum loss all the way here is minus $540. No matter what happens to the VIX, if it goes down to 9, if it breaks to new all-time lows in the 8s, we can still only lose a maximum of $540. Now, because we are paying the premium, that also means that it's a lower probability trade. We actually need the VIX to go up quite substantially in order to just break even. At expiration, we can take the 13 strike, which is the one that we're buying, and we can add the premium of $540, and we can see the break-even point is $18.40. 100 days from now, we need the VIX to go up substantially to make a profit. However, again, we are only looking at the pink line, so you can see as I start going up, we can start to make profit immediately on a day-to-day basis, which is what we're interested in. I will not be keeping this contract open for very long. Couple weeks, maybe a month, but if nothing materializes by then, I'd probably be looking to close it for a small loss. So your software probably does something quite similar, but we can check out the Greeks here. So the first one is delta. Again, we're looking at this pink line. You can see that it's a positive number right there, $71.48. Remember, delta is the sensitivity to an option's price. So if the VIX index goes up by 1, the option contract will gain $71.48. A positive number, it's delta positive. This is a bullish trade, and we want the VIX to go up. The next one is theta, and of course we are expecting a negative number here because it is a trade that bleeds capital. Right there at today's price, minus $2.48. Now that may not seem like much, but remember it is a daily decay and it does add up over time. I can actually do a little bit of a theta adjustment here. You can see right now we're basically at zero, but if I move forward 1 month, our expectation is that we might be down nearly $100. That is simply because of the theta decay. The price would not have moved, but that daily decay does add up over time. So that's the theta, and it is something to be concerned about. That's why I say we're not going to be holding this open for very long, certainly not until February. Now, the last Greek we'll look at is Vega. Now, long calls are Vega positive. You can see 2.19, which basically means if volatility rises by 1%, the option contract will gain $2.19 in value. Again, we can do another volatility adjustment, so you can see we're hovering around zero again. I can go over here, and let's say we add 10%, which means volatility goes up 10%. Well, we'd be in positive range. We'd now be at 10.50. If it goes up 20, again, now we're at $32. We're gaining value. The price isn't moving, but if volatility goes up, we can actually make some money here. That's what long Vega does for us. But remember, the flip side is true as well. If volatility decreases further, we would be losing money. You can see there, it dropped down to minus $36. But actually, long calls are basically bullish trades. I tend to think of them as delta trades, even though theta is an issue. That's why I go further out in time so I can take care of that bleed and make it very low day to day. And Vega affects it as well, but again, it's not the focus of the trade. This is a price trade. I'm basically just looking for the VIX index to see some type of short-term spike. If it happens, great. If it doesn't, within a month or so, I would close out the trade and look for something else. But that's a long call on the VIX index. It would work exactly the same if it was an individual stock. But again, like I said, right now I'm not really seeing anything that attractive. And the VIX getting to these low levels does get my attention, so that's the one that I chose. So that's the basic long call. Now just to review some of those points, it is a very bullish trade. Only really appropriate when you're expecting the underlying to go up substantially. It's a delta positive trade, meaning we do want the price of the underlying to go up. And remember, because it is a theta negative trade, not only do we want the price of the underlying to go up, but we also want it to happen sooner on in the options life cycle. The longer we let these go, the more that negative theta eats away at the value of the option. And that last Greek, they are Vega positive, which means they do profit from increases in volatility. So opening them when volatility is relatively low as a starting point is the higher probability trade. Now, these are limited loss trades with that maximum loss capped at the premium paid. Of course, we can't lose more than that. And they're unlimited gain, which means if you do catch one of those high flyer stocks, the profit can be quite substantial. The flip side is, because that break-even point is the strike price plus the premium, this does make them lower probability trades. And most long calls, if left alone, they will expire worthless. But that's the long call. And while I don't personally trade them very often because I tend to favor the higher probability option spreads, they are fundamental to all of option trading, so we do want to get a really good feel for them. Now, understanding the structure of the trade is only the first step, but the really important part is how to actually use them within the context of a broad portfolio. And for that, you can head on over to my website, claim your free trial, and follow a number of my live trades firsthand to see if the VTS community is right for you. Thanks for watching. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: Iron Condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.